So I was recently thinking about a way how to actually measure wealth that goes beyond just using US dollars. Because what we want to do is, right, when we want to measure our capital wealth, right, our liquid wealth, for example, we want to find out over the years, right, over 5 or 10 or 15 years, how much more are we actually growing? How much better are we getting at, feeling safer, at having more purchasing power, etc. And the US dollar is pretty bad at this, right? Because of the inflation rate. If we say double our wealth within 10 years, are we really getting ahead, right? Because maybe the study fees might have doubled, maybe medical expenses might have doubled, maybe property prices might have doubled. So the US dollar is probably a bad denominator to figure out material wealth. So we have to probably look at something else if we want to measure this over the long period of time. One straightforward way that some people do is they just measure this in gold coins. As in, the idea is you want to denominate your US dollar wealth by the gold price, see, okay, my wealth is worth X amount of gold coins. And what you want to do is kind of like get the inflation rate baked in, right? The kind of like hidden inflation rate, the gold price or a gold coin itself should have some kind of stable purchasing power. That's the idea. Now we've seen in the last 10-15 years that this actually didn't work too well, right? The gold price is still relatively volatile, so you go from one month to the next in relatively strong changes in your wealth without you having actually done much. And at the same time, you might actually not really keep up with inflation because the gold price might not actually rise as quickly as hoped. So I think even though it's probably better than using the US dollar to a certain degree, it's still not optimal. So what else can we do? I think for most people that are just starting out doing this kind of exercise, for most people at the beginning, it's probably best to measure wealth in monthly expenses. Because when you measure your monthly expenses, you basically have the inflation rate over the long term, your personal inflation rate baked into this whole calculation, right? Everybody's inflation rate is actually different. Right? If you have a large house, house price increases affect you more than if you've got a small house. If you drive a lot around, then the gas prices might impact you more. So the monthly expenses are a direct reflection of your personal inflation rate if you spend the same every month. This also then gives you a warning sign, right? If the monthly expenses grow faster than, say, your savings, that suddenly you actually get poorer, and you get poorer relatively quickly, right? You double your monthly expenses, suddenly you only have half the wealth. Now, why is that so good to measure this in months of expenses, right? Say you have got 12 months of expenses. It helps you keep the expenses low. You feel richer by lowering the expenses, and it's also a direct reflection of the freedom you have, right? So if your most important thing when accumulating wealth is to be free, to maybe quit a job one day, or to work a bit less, or things like that, or to maybe retire, right? When early retirement is the thing, then measuring this in monthly expenses makes most sense. And then you can actually also start becoming more creative around things, right? How can I reduce my monthly expenses without necessarily getting my lifestyle down too much? So then maybe it could, we can come to conclusions such as maybe we should move to a cheaper country, because then we've got lower monthly expenses. Suddenly we've got our wealth doubled or tripled. So these are some kind of ideas that are good with measuring this in monthly expenses. The problem though is when we invest, right, we don't just want to keep our money in cash, and we still have the inflation. So we have to invest into something. And then we can actually start measuring the wealth in other things. So I personally think once you are beyond the, say, 12 months or so of expenses saved up, then you already feel relatively safe. And if you don't want to retire, say, in 5 or 10 years, if you're not like the early retirement crowd, then probably something else matters to you more. And so what we could then think of is to actually measure wealth in comparison to others. So now the focus is not anymore just to be safe, but now the focus is more on climbing the social ladder, so to speak. Okay, so we want to outperform everybody else. We want to have a higher standard of living. We want to be able to spend more in the end, of course. But the main thing first is to basically grow wealth quicker than others. And so then we can just have a benchmark of what's our benchmark for wealth growth. And one straightforward way would be to just divide the wealth by, say, the Nasdaq 100 or by the S&P 500. Right? So by a stock market index. Because if we do that, then and we say we dollar cost average into stocks, then a lot of the volatility of the stock market then is gone, right? Because most of our money is in stocks, then we're not really that concerned anymore with going up and down. And of course, the wealthier crowd, they also ride all these waves out, right? They also go up and down. But if your wealth denominated in the stock market index grows over time, then you are getting ahead, right? You've got more and more shares, so to speak, of the index, and so you can focus more on relative outperformance. Now, there's also the idea, and this is in the end the crypto channel, to just go ahead and measure the wealth in Bitcoin. Of course, the problem here is, again, the volatility, right? When Bitcoin goes down by 2/3, it goes down by 66%, and you don't have all your money in crypto, which makes sense not to do that, right? It makes sense to diversify to a certain degree. If you measure your money in Bitcoin, you suddenly get way richer just because we had a crypto winter. But how is that measure really useful? What I do think, though, is it does make sense to measure a certain fraction of your wealth in Bitcoin. So if you're actively trading, right? If you're actively trading altcoins, for example, you go in and out of altcoins, or you do certain DeFi plays, and you have the conviction that Bitcoin over the years, right, like say over 5 or 10 years, is going to increase in US dollar amounts, then it probably doesn't make too much sense to measure the active trading portfolio in US dollars. Because you don't just want to earn US dollars, you don't just want to earn some money that you can directly spend. What you do with this altcoin trading ideally is you want to outperform Bitcoin. You have Bitcoin as a benchmark, and if you do nothing, you get the Bitcoin returns. So when the attempt with trading is to actually be better than Bitcoin, then that's the only thing that matters. So you should then measure the active trading portfolio by the Bitcoin price. Divide that portfolio by the Bitcoin price, and then you've got, I don't know, 1.5 Bitcoin, 2.5 Bitcoin, whatever it is. That's then your active trading. And then when the Bitcoin price goes down, then of course your active trading portfolio is likely also going to go down. But if it goes down less than Bitcoin did, then that's great. And when it goes up more than Bitcoin does during a bull market, that's also great. So that then makes sense. So you always want to, that's how I see this now after all of this thinking, you always want to think of what's actually the target when you measure wealth. What do you actually want to focus on? Do you want to focus on freedom? That makes sense to measure this in expenses. Do you want to measure this as in getting ahead in life relative to the overall population, not falling behind at least? Then it makes sense to measure this in terms of a stock market index. And then if you're doing some kind of active trading and you've got something that you could earn anyways in a passive way, then probably it makes sense to also measure this again against the benchmark. So if you do stock trading, measure this against the stock market index. If you do crypto trading, then measure this versus the safest of the cryptos, which is Bitcoin. So that's how I personally actually do this. So I started out with measuring this in monthly expenses. Now it doesn't matter that much anymore. I don't want to early retire, at least, I don't want to retire in like 5 years, maybe in 15. So the monthly expenses aren't that much important for me anymore, but I do want to make sure that I do not fall behind the rest, right? So I do want to make sure that I save enough every month, and that I don't get a distorted view just because we get a stock market crash, that I suddenly am not keeping up anymore because everybody is falling down. So it's fine if I fall a little bit as well. So I personally, I like to divide my liquid wealth by the Nasdaq 100. And then for my active trading portfolio, I also do this. I divide my active crypto trading portfolio by the Bitcoin price to see if I outperform Bitcoin. And that's then how I get my measures of what I think makes most sense in my particular way. So I hope that was useful. Feel free to also do the same kinds of calculations. If you're just starting out, just measure this in expenses. Otherwise, measure this against the benchmark that is most relevant for you. Hope that video was useful. It's a bit of a different type of video. I've got another video where I discuss the current state of the bear market. Feel free to check out that video over here. Thanks for watching this video and see you in that other video. Bye bye.